Is Bitcoin really just reacting to price swings, or is it reflecting deeper forces in the global financial system? If liquidity is disappearing and central banks are tightening, why does it feel like ordinary investors are always one step behind? And if Bitcoin is designed to survive financial storms, why do crashes still shake so many people's confidence? According to Joe Consorti, the real driver isn't sentiment or crypto news, it's liquidity. The movements we see in Bitcoin are a mirror of systemic cash flow, and understanding this pattern is more important than obsessing over the price. Those who grasp it early can position themselves before the next major liquidity shift hits, while everyone else reacts too late. Hello everyone, and welcome back to our channel. This podcast summary video is based on Joe Consorti's recent appearance on What Bitcoin Did, where he delivered one of the clearest macro explanations for Bitcoin's recent price action that we've heard in months. The conversation dives deep into technical levels, liquidity cycles, Federal Reserve policy, political incentives, and why Bitcoin may be evolving into something much bigger than a speculative asset. The whole conversation is over an hour long, but we listened to it all and organized the most important ideas into a clear, straightforward summary, so you get the key takeaways without having to listen to the full episode. If you get value from our summaries, please like the video, subscribe to the channel, and comment your thoughts below, because that really helps the channel and keeps this content coming your way. Joe begins by making one thing very clear. This recent drawdown in Bitcoin is not a Bitcoin native failure. It's a liquidity contraction. In his view, when global liquidity tightens, every risk asset feels it, and Bitcoin is no exception. Bitcoin does not trade in isolation. It trades inside the same financial plumbing as equities, credit markets, and global capital flows. When liquidity expands, Bitcoin accelerates. When liquidity drains, volatility spikes. He points to the structure of the move itself. Bitcoin didn't slowly grind lower. It dropped sharply into a thin zone with limited historical volume support. That's what traders call an air pocket, a region where price previously moved so quickly that it never built a strong base. Once price falls back into that zone, there isn't much structural support to slow it down. According to Joe, that's exactly what happened. The speed of the decline reflects liquidity evaporating, not a collapse in the long-term thesis. And here's the key twist. Joe argues that this kind of violent move is typical during transitions between liquidity regimes. It feels chaotic in the moment, but it's mechanical. Markets are adjusting to tighter financial conditions. They're not collectively deciding that Bitcoin has failed. Joe then grounds his macro thesis in hard technical levels. He highlights the 200-week moving average and the 2-year moving average as long-term structural baselines that Bitcoin has historically respected. These aren't short-term trading lines. They're cycle-defining trend indicators. As long as price remains above these structural supports, the broader uptrend remains intact. He also discusses the relative strength index and points out signs of momentum divergence earlier in the cycle. In simple terms, price was pushing higher, but momentum wasn't accelerating at the same rate. That kind of divergence often precedes corrections. It doesn't guarantee timing, but it signals that a move may be running out of energy. According to Joe, the warning signs were already there. What makes this more compelling is how the technicals align with the liquidity story. When momentum cools at the same time liquidity tightens, downside moves can accelerate fast. That's when corrections feel emotional and chaotic. But Joe is careful here. He does not frame this as structural damage. He frames it as a reset within a larger macro cycle. This is where the conversation widens beyond Bitcoin. Joe explains that Bitcoin remains highly sensitive to equity markets, especially during liquidity contractions. If equities struggle, Bitcoin often experiences amplified volatility. And right now, equities themselves are navigating an environment shaped by interest rate policy and political incentives. He brings up the Federal Reserve and the possibility of future rate cuts as economic pressure builds, especially heading into the midterm election cycle. Policymakers have strong incentives to avoid prolonged asset price weakness during politically sensitive periods. Whether through rate adjustments or broader financial easing, markets often anticipate these shifts before they are formally announced. Here's the subtle implication. If liquidity tightens too much and asset prices fall too far, pressure builds for intervention. And when intervention comes, it often reignites risk assets aggressively. So while today's environment feels restrictive, Joe suggests it may be setting the stage for a future liquidity expansion. And historically, Bitcoin reacts violently when liquidity turns back on. One of the most forward-looking parts of the discussion centers on Bitcoin's evolving role inside the financial system. Joe argues that Bitcoin is increasingly being viewed not just as a speculative asset, but as pristine collateral. Traditionally, U.S. Treasuries have served as the ultimate collateral base for global finance. But in a world of rising sovereign debt and growing distrust in fiscal sustainability, alternatives begin to matter. Bitcoin offers something unique. It has a fixed supply of 21 million coins. It is globally transferable. It is politically neutral, and it operates outside any single jurisdiction. Joe suggests that over time, institutions and even sovereign actors may begin integrating Bitcoin into collateral frameworks. This transition is gradual, but the direction is meaningful. This ties into what he calls the horizon model. As traditional assets like home equity inflate in nominal terms due to monetary expansion, individuals may increasingly extract that value and store it in Bitcoin. In other words, they convert equity from an inflating asset into a harder one. If this behavior scales, Bitcoin becomes embedded in household balance sheets as long-term savings infrastructure, not just speculation. So, where does this leave us? According to Joe, we are in a liquidity-driven bear phase, not a Bitcoin-specific collapse. The short-term technical damage looks dramatic, especially when price falls into low-volume zones. But structurally, as long as the long-term trend levels hold and liquidity cycles eventually turn, the broader thesis remains intact. The deeper story is not the correction itself. It's the transformation happening underneath. Bitcoin is slowly integrating into the financial system as settlement infrastructure, as collateral, and as a hedge against sovereign debasement. These changes do not happen loudly. They happen quietly through capital flows and balance sheets. And this is the cliffhanger Joe leaves us with. If this downturn is primarily about liquidity, then the next expansion phase could be explosive. The question is not whether volatility will continue. It will. The real question is whether you understand the regime you're in. Because if this is a liquidity reset before another expansion cycle, what feels uncomfortable today may look obvious in hindsight.